Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 52, titled Making Money Selling Options with Technology Stocks. And we're going to use a real-life example with Invesco QQQ Trust, which trades on the NASDAQ exchange under the ticker symbol QQQ. Now, most of you are probably familiar with the fact that the large cap tech companies are quite expensive. So to sell covered calls or cash secured puts, particularly covered calls, can be challenging because with covered call writing, we have to first buy the stock before we sell the option. And of course, with puts, if the put is exercised, we then have to take possession of those stocks and we have to secure the put with a large amount of cash. So what we're going to do is we're going to talk about a way of incorporating these large cap tech companies into our option selling strategies using the exchange traded fund QQQ. So what this ETF is, it's an ETF that consists of 100 of the largest non-financial companies that trade on the NASDAQ exchange. In essence, they are blue chip or solid companies with large cash reserves, but they are technology based. So the premiums that will generate selling options against QQQ will be significant, as you will see in a moment, particularly when you annualize the returns. Now, if we took a look at the top holdings of QQQ in 2020, we would see companies like Microsoft, Apple, Amazon, Facebook, Google or Alphabet, Intel, Netflix, Pepsi, and Cisco. So those were the top 10 holdings, all huge blue chip technology related companies for the most part. And so when you buy one share of QQQ, you will in essence be owning 100 shares of these different tech companies. So at least pieces of them. So that's how the ETF works. Now, if we took a look at the call option chain, first, let's look at the call side. When QQQ was trading at 175.55, we would look at the following at the money strikes. We'll call them near the money, but slightly out of the money. 177, 176.50, and 176, all out of the money. Now, the pricing on these securities will be fed then into the Ellman calculator. Now, the 176 strike generated a premium of 388, and that would give us a return on our option or ROE of 2.2% for our initial time value return. Now, if QQQ went up to 176 from 175.55, it would generate an additional 0.3%. So there's an opportunity with this trade for a maximum 1 month return of 2.5%, and that annualizes out to 30%. Now, looking at the 176 slightly further out of the money strike, we would have a return on our option of 2.1% with an opportunity for an additional 0.5 on the upside. So 2.6, slightly higher for the 176.50 strike. Now, if we go to deeper out of the money to the 177 strike, that would give us a ROE or return on our option of 1.9% with the possibility of an additional 0.8. So a max return of 2.7%. So all of these returns annualize out with the upside to 30% or higher. So as I said, a fairly significant premium, even though it's an exchange traded fund, which consists of baskets of stocks. ETFs generally generate lower returns than individual stocks because they're less volatile. But in this case, very significant returns with the Qs. Now let's then turn to a put option chain, also 1 month out. And we would look at the out of the money for puts is lower than current market value, which again, was 175.55. So if we took a look at the 174, 174.50, and 175 strikes, we would see premiums of 362, 381, and 401. Now, if we fed this information into the BCI Put Calculator, we would see the following initial time value returns. For the 175 strike, 2.35%. For the 174.50 strike, deeper out of the money, 2.23%. And for the 174, deepest out of the money of the three, 2.12%. So all of them greater than 2%, which would annualize out to 24% or higher. So also very substantial. Now with cash secured puts, the max return is the put premium. You know, exit strategies aside, that's our max return. So there's an opportunity for higher returns with covered call writing when we're using out of the money strike prices. But still in all, very significant returns with cash secured puts as it relates to the Qs. So to summarize, generating cash flow on technology-based stocks can be accomplished in a very conservative yet powerful manner by using QQQ, which consists of 100 of the largest non-financial companies that trade on the NASDAQ exchange. And the initial time value returns annualized can easily exceed 20%, as it did in all the examples, 6 of them, which I gave you in this podcast. And certainly we'll keep a lion's share of it when we manage our trades properly, and especially in normal to bull market environments. There's great opportunity selling options against the Qs. Now, before I close up this podcast, as I usually do, I just want to invite you to take advantage of all the free resources on our website, www.thebluecollarinvestor.com. Check out the top black bar of our web pages. Look for the free resources link. To have a look at the Google search tool, where you can look up various articles I've published, over 400 of them over the years. If you go to our blog page, you could sign up for our free newsletter. And certainly visit our store, thebluecollarinvestor.com/store, where we have online videos, calculators, spreadsheets, ebooks, soft and hard covered books, as well as trade planners and online mentoring programs. So there's a lot of educational products available to help us achieve the highest possible levels of success. So I want to thank you, ladies and gentlemen, for taking the time to listen to this podcast, BCI Podcast number 52, Making Money Selling Options with Technology Stocks. And we used the Qs as a way of accomplishing this at a very low cost to us. So once again, I want to say thank you. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.